Citi, first of all, is courageous to be the first one out. I don't recall when Citi has been alone to kick off large bank earnings.
Is there anything surprising here?
The surprising, I think, is really related to Friday with the value line announcement. But today's results, not looking at all the details, they're fine. The area of weakness is the capital markets. FIC down this quarter, as Wilbur said, Q3 up 9%. The areas to look at is what did they do to drive loan growth? What is the risk with deposits and betas? From the Fed in Q3 on senior loan officers, we've seen that it's gotten really competitive on the commercial side. We've also seen that covenants have lightened up. Spreads have tightened. Consumer is rock solid. That's driven mostly by a dominant position in credit cards and also consumer loan growth. Costs really is one ratio to sum it all up. The efficiency ratio, it's been about 56%. Not much more opportunity looking to next year. So then we say, what's the bull case here? We're cautious on the fundamentals for next year, but you got a stock trading below book value. You have a return of capital of $22 billion since last June. That flows for the first 6 months of next year. And, so many things can be indicating of slowness. Earnings growth for this bank and others for 2019 are going to be slower. The earlier comment just related to the tax rate, the year-over-year comp starting with Q1. Typically, the first time might be challenging because it's not going to be so easy.
Kenneth, let me ask you just about the volatility in the markets. That's something you said and that Citigroup also points out in its release. It says the volatile fourth quarter impacted some of our market of sensitive businesses, particularly fixed income, as you pointed out. We were looking at all those years of no volatility and saying that was terrible for all the trading desks, that they couldn't get the volatility which would help them out so much. Is it a situation where it's bad news and to have volatility and it's bad news to have no volatility too?
Sure.
Does it depend on if you're good traders or not?
There's two tales of the story. The more plain vanilla is equity. Yeah. So typically with more volatility, you would expect clients to get in, but that may not have been the case in Q4. FIC has been managing the business with regulation, protecting your capital, not taking as much risk, right-sizing the business. Citi did that, I think, fine. What we're seeing here is a lot, both on equity and fixed income, a lot on the sidelines.
I would be, I'd be disappointed if I were just managing one of these banks because you've got sub 4% unemployment, you've got a strong consumer, you've got credit improving, you got wages improving, and I'd say, where's my steep yield curve? I demand my steep yield curve. Where's my steep yield curve? Why can't I make money that way? I mean, that's the whole point, isn't it? Now, why do we have a flat yield curve when everything's so great? It's not fair.
It is, because it ties to two things. For Citi and other banks, how do they make money on net interest income? And then second, the macroeconomic environment. Now, Citi has less revenue coming from the U.S., so this is a global play. Right. Their story and the beauty is we're well networked to tie in institutional flow, financial or corporate. So that means Southeast Asia, it means Latin America with Mexico. So Citi's doing a good job.
Is Citi an indicator, though, of what we're going to be hearing over the next 2 weeks, effectively, from everybody else, or do you think they're an outlier?
I think in the capital markets, it's going to be very similar for the other large banks. I think to Joe's point, just on why can't you make more money as it relates to yields, it's going to be really tough. Surprises that you can get anywhere here that's different would be just some slight gains or losses in market share in the league tables.
But you look at this list that's coming, JPM and Wells Fargo, which we'll be hearing about tomorrow. So
yes.
You think exact same story. I'm assuming Goldman and Morgan should be in a bit of a different place depending on the trading revenue?
It may or may not be. The question was, when you look at Goldman or Morgan Stanley, it's more what's coming from prime brokerage and from the hedge funds.
Right.
And was it automated trading in December, or was it lots of participation? That's just the trading call. Then you got to look at these stocks. They're down a lot. Goldman, which we have a buy on, is sold off the most. I think they have more of the delta on the upside.
You look at this list in front of you right now. Who do you like the most? Who do you like the least?
So we have buys on Goldman Sachs and also JP Morgan. Goldman, because it got really beat up last year, and I see upside. JP Morgan just executes beautifully. You know, it's a continual story for us. We have a sell in Wells Fargo, mostly because brand damage, the Fed asset freeze. At the end of the day, it's hard to run a business and have all that attention to run the business and be compliant. Citi's fine, but you got that emerging market risk. Bank of America, good block and tackle. They missed an investment banking last quarter, so we essentially have a hold recommendation on that.